How to Reduce Taxes on Your Social Security by Dan Hopwood. My name is Dan Hopwood. I'm of the Retirement Planning Store. The Retirement Planning Store has an A+ rating with the Better Business Bureau. You can go to bbb.org, check us out. We're located in Mapleton, Illinois. That's my picture over there on the right. I'm a member of the National Ethics Bureau, ethics.net. You can go to ethics.net and check me out. You'll find out that to be a member of the National Ethics Bureau, you have to have a 7-year extensive background check done on you. And if you have any skeletons in your closet, you cannot be a member. So the amount of the tax depends on two things: your marital filing status, if you're single or married, and the amount of your income. The tax on Social Security retirement benefits was put into effect in 1983. Tax was applied up to 50% of the benefits, and we can thank President Ronald Reagan for that. And then President Clinton decided that 50% wasn't enough, and he decided to increase that tax up to 85%. So the first step is to calculate your provisional income. And the way to do that is to go grab last year's tax return. You go do that and pause this and come back and continue afterwards. So you subtract your taxable Social Security benefits, line 20B, from your adjusted gross income on line 37. Add 1/2 of your Social Security benefits on line 20A. Add the tax exempt interest on line 8B. The result is your provisional income. Once you know this number, you can apply the rules to determine how much of your Social Security is taxed. Again, this depends on whether you are married or single and the amount of your income. Let's look first at a married couple filing jointly. Here's the math. If your provisional income is below $32,000, you don't have a problem. For provisional income over $32,000, you take the provisional income between $32,000 and $44,000 and divide it by 2. If your provisional income is above $44,000, take the total provisional income, subtract $44,000, and multiply by 0.85. Add 2A and 2B, multiply your Social Security benefits line 20A by 0.85. The lesser of your result on 2C and 2E above is the amount of your Social Security benefit taxed. Now let's look at the calculation for a single person. If your provisional income is below $25,000, none of your Social Security benefits are taxable. For provisional incomes over $25,000, take the provisional income between $34,000 and $25,000 and divide it by 2. If your provisional income is above $34,000, subtract $34,000 from the total provisional income and multiply by 0.85. Add 2A and 2B, multiply your Social Security benefit line 20 by 0.85. The lesser of your result on 2C and 2D above is the amount of your Social Security benefit taxed. Now that you know whether or not any of your Social Security benefits are taxable, and if so, how much, the next step is to take a look at the ways you can reduce or eliminate this tax. The solution is reducing your interest income. The most common is interest on CDs and mutual funds. Reduce your dividend income and reduce your tax-exempt interest income. You see that here, the male putting in $100,000, he's 65 years old. Well, let's say he's 80 years old and he starts needing some care. Well, you're going to have 2% of $277,000, or if it only earned 5%, you'd have 2% of $205,000. You'd have $4,100 every month that you can draw upon to pay for care. And if you never use this plan, or you die, you know, the money comes out tax-free, and it avoids probate, and money is paid directly to your heirs. So if you would like an illustration of your own, feel free to give me a call at 309 696 8905, or you can simply email me at dan@retirementplanningstore.com. Thank you for watching today. I hope I've answered a lot of questions for you, and if I can help you, give me a call or email me. Thank you.